Hello students, welcome back to Brain Power classes. Today we are going to see class 11th economics chapter number 9, economic policy of India since 1991. This is part 1 of our video. So in this video we are going to learn introduction of the chapter, objective, features and till liberalization. So why India introduced a new economic policy in 1991? So we are going to study in this chapter. So let's begin with the introduction. At the beginning of 1990s, the Indian economy faced a serious economic crisis. So India's foreign exchange reserves had fallen so much that they were sufficient for only 2 weeks of imports. So at the same time, inflation reached 16.7% in August in 1991. You can see here, it is mentioned here. So, government expenditure was higher than government revenue. Large amounts were spent on defense, subsidies, and interest payments. So, because of these problems, India needed major economic reforms. So, therefore, in 1991, you can see here, in 1991, the government of India introduced the new economic policy, that is NEP. Hence, the government of India adopted a new economic policy NEP in 1991, and the new industrial policy aimed to remove unnecessary government controls and make industries more efficient and competitive. So, under this policy, the government would act mainly as a facilitator, coordinator, inspirer, and supervisor rather than a collector. Now, let's see the main objectives of the economic policy of 1991. First is globalization, to plunge the Indian economy into the arena of globalization. That is to integrate India with the world economy, to bring down the rate of inflation, to reduce the rising prices of goods and services, to to correct the disequilibrium in the balance of payments, to improve India's international position, to acquire higher economic growth rate, that and fifth one is to build sufficient foreign exchange reserves, to achieve economic stabilization and to reduce fiscal deficit, to establish international trade relations for free flow of goods without any restrictions, and to increase the participation of private sector. So the objectives are globalization of the Indian economy, that means to integrate India with the world economy. Second is control of inflation, to reduce the rising prices of goods and services. Third is correct the balance of payments problem, to improve India's international payment position. Fourth is achieve higher economic growth, is to increase production, income, and employment, and to maintain. And the fifth one is to build foreign exchange reserves. That means to maintain sufficient foreign currency reserves. Six is economic stabilization and fiscal deficit reduction, that brings stability to the economy and reduces government deficits. Promotes free international trade. You can see here, to establish international trade relations for free flow of goods and services. It establishes trade relations without unnecessary restrictions, and the last one is to increase the participation of private sector. It will encourage private businesses and industries. Now, let's begin with the features of the economic policy of 1991. So, first feature is delicensing. So, what does delicensing means? The abolition of government license required to carry on any business or industrial activity. It means delicensing means removing the requirement of a government license for most industries. Today, compulsory licensing is required only for electronic, aerospace, and defense equipment, industrial explosives, and the hazardous chemicals, drugs, and pharmaceuticals, and cigarettes. And other industries don't require licensing compulsory. Second feature, we have abolition of monopolies and restrictive trade practices, MRTP Act. So MRTP stands for Monopolies and Restrictive Trade Practices Act. So earlier, large industries needed government approval for establishment, expansion, and merger. Because of this, the slowed the slowed the industrial growth, and its abolition encouraged industrial development. Encouragement to small sector. So the government promoted small industries to increase production, employment, and exports. Investment limit was increased from 1 crore to 5 crores. Encouraging foreign investment. Foreign direct investment, that is FDI, was allowed. Industrial policy of 1991 approved the direct investment FDI to encourage investment in high priority industries required high investment and technology. So foreign direct investment FDI was allowed. Initially FDI was up to 51% was permitted, later increased to 74%, and then 100% in selected industries. So this brought foreign capital and technology. Reducing the role of public sector. The main objective behind reducing the role of public sector is to ending state monopoly and improving efficiency, releasing capital blocked in sick enterprises. So industries reserved for the public sector were reduced from 17 to 8%. At present, only railways, atomic energy remain reserved for the public sector. Trade liberalization. Import licensing import licensing controls abolished. So capital goods and raw materials made freely importable. External credit allowed for exporters. Special economic zones are set up to promote exports, and agro export zones is encourages agricultural exports. They were also introduced in this. Next, we have reforms in insurance sector. So earlier, insurance was completely controlled by the government. The Insurance Regulatory and Development Authority Act (IRDA) was introduced in 1991. You can see here, insurance sector was a monopoly of the government. The new policy passed Insurance Regulatory and Development Authority Act (IRDA) in 1999 to introduce reforms in this sector. So the IRDA has given license to many private companies to enter insurance business. This has ended the monopoly of government in this sector. Private companies were allowed to enter the insurance business, and this ended the government monopoly. Reforms in financial sector. Earlier, only cooperative bank and public sector banks were permitted to do banking businesses in the financial sector. But after reforms, private banks were allowed, foreign banks are allowed. This increased the competition and the efficiency. Now, let's see the components of new economic policy. So, new economic policy NEP has its three components LPG, that is liberalization, privatization, and globalization. So, first, we are going to see the first component, that is L, that is liberalization. So, what does liberalization means? So, liberalizations means economic freedom. Liberalization refers to the economic freedom or freedom for economic decision. It means producers, consumers, and owners of factors of production are free to take decisions to promote their self interest. So, it allows producers, consumers, owners of factors of production to take their own decisions, to take decisions according to their self interest. And according to Adam Smith's, economic freedom promotes growth and welfare. Liberalization means reducing the government restrictions and encouraging free competition. Now, what are the measures taken for liberalization? First is flexibility of interest rate. Commercial banks were given freedom to decide interest rates and according to market demands and supply. Next, we have freedom for expansion of industries. Earlier, the government fixed production limits. Now, industries can expand production, diversify products, reduce costs, and according to market requirements. Third, we have abolition of monopolies and restrictive trade practices, that is MRTP, abolition of MRTP restrictions. So, according to MRTP Act of 1969, all those companies having assets worth of Rs 100 crores and more were classified as MRTP firms and were subject to several restrictions. Now, these firms have the freedom to take investment decisions. So, large firms with assets above 100 crores were earlier restricted. Now, they have freedom to make investment decisions. Reforms in FERA. Now, Foreign Exchange Regulation Act FERA was replaced by FEMA. FEMA stands for Foreign Exchange Management Act, and this encourage the international trade and foreign exchange transactions. Investment in infrastructure. Now, both domestic and foreign investors are allowed to invest in railways, roads, and power projects. And earlier, it was not there, so now it was introduced. Encouragement to foreign technology. High priority industries were allowed to use foreign technology. So what were the benefits after this? So benefits were low production cost, better quality, and high competitiveness. SEBI, Securities and Exchange Board of India. It was established on 12 April 1992, and SEBI stands for Securities and Exchange Board of India. It functions for protect investors, regulate securities market, and promote market development. Now, in this part, we have seen economic crisis of 1991 that we studied in introduction part. Objectives of new economic policy, features of economic policy 1991, meaning of liberalization and measures of liberalization. Now, in next lesson we will study in next part, sorry, not like next lesson, next part, privatization, globalization, achievements and failures of the economic policy of 1991. So see you in next video.